As stock markets face the Fed once again, with expectations firmly anchored on a rate cut, not only at this meeting, but at the one to follow, is there anything for the markets to gain in this outcome? Or do they have everything to lose now that they are priced for? That's what we're going to figure out here. Macro Money starts right now. Welcome to Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And as advertised, we are going to take a look here at this Fed monetary policy announcement that is going to be with us here in the next, less than 24 hours. That's easily the tentpole event risk for the week, but it's certainly not the only one. This midweek pocket here this Wednesday is going to give us some huge earnings, and it's going to give us a breakthrough maybe in the U.S.-China trade kerfuffle that we've been watching. So let's consider what we have happening here in the markets going in and what all of this stuff may do. And of course, the top of mind question here is going to be, are we going to get anything from the Fed that still has speculative juice behind it to move these markets, or are we already fully priced for what there is to see? So let's start here with the way that these markets have performed over the past 24 hours. Not surprisingly, not the most enthusiastic way forward, and not the most convincing one either. A slight eking out of gains for the S&P, up just a bit over 0.25%. NASDAQ doing a little bit better, and in fact, tech has been leading, coming out of some of the recent unpleasantness, in particular, of course, at the start of this month. October 10th was a big, ugly day for all involved on Wall Street around these U.S.-China trade war escalation fears, but those have been increasingly put to bed, and against that backdrop, we've seen earnings seemingly take center stage, even as Washington and Beijing attempt to kind of walk back the worst of the kerfuffle here. And so as we get earnings results, and we'll take a look at some of these averages here momentarily, it's clear that tech has been leading on the reporting front. And so not surprising, really, that it's been leading on the price front also. No big changes today for the fixed income space. The 10-year, the 2-year leak a little bit lower, but ultimately no big changes there. Crude oil coming back after having spiked significantly. We can see that last week we had this massive 7.6% run-up around the idea that the U.S. has essentially told markets that either they do business with Lukoil and Rosneft, two of Russia's biggest oil companies, or they do business with the U.S., but they can't do both. This kind of mirrors the way that the U.S. squeezed Huawei, China's Huawei, out of the 5G cellular market, the 5G mobile market, basically saying, if you do business with them, you can't do business with the U.S., essentially adding the entity itself onto the list of restricted counterparties that the U.S. keeps. This has now been done to these oil companies. That's a direct swipe at Russia's ability to sell oil on the black and the gray markets and sort of circumvent sanctions. And basically to say, okay, well, we're not going to try to compel Russia. We're going to try to compel the buyers of Russian oil. And that, of course, puts a target squarely on both India and China, the most prodigious buyers. And that, of course, gave us a big spike around the idea that this may increase what crude costs, because, of course, they've been buying it at steep discount. Russia's, after all, got to sell in size to someone, and beggars can't be choosers. So what we end up with today is a kind of moderating of that move, perhaps in anticipation of some sort of a grand bargain to be done when the U.S. President Donald Trump and his Chinese counterpart Xi Jinping meet in but some hours here on the sidelines of the APEC, the Asia Pacific Economic Cooperation Conference, taking place in Busan, South Korea. We have gold leaking a little bit lower as well, perhaps again around the idea that some of those tensions are going to get relieved. And the dollar here is pretty well steady. The euro is essentially flat. The yen is a touch higher, but ultimately not getting very far. That seems to be around the friendly banter that Donald Trump had with Japan's new Prime Minister Sanae Takaichi, and how that's gone forward. Bitcoin, a little bit soft-footed here, off about 2%, but ultimately not getting very far either. On to the Fed meeting, where, of course, we have overwhelming likelihood that this rate cut is going to happen. 99% chance now that we are going to get a 25 basis point cut. Markets aren't even considering the idea of anything else at this point. And looking into December, we've gotten a little bit lighter in the level of certainty. In fact, we're down meaningfully off where we were a week ago, and down even from where we were yesterday. And we can see that's coming because the possibility of a hold is starting to creep ever so slightly higher. But to put that in context, the likelihood of a hold now is only about 9%, whereas the likelihood that we are going to get the cut is 90.8%. So it's about a 91 for, 9% against that we're going to get a cut. So still very, very convincing. And of course, coming into this, we just got that special dispensation CPI report that was released despite the government shutdown, and some moderately helpful guidance here, if you will. The headline number rising, but not as much as expected. 3.1% was expected. The core actually easing back from 3.1 to 3. So both end up at 3, but in different ways. We can see that for core services, which is easily the biggest contributor to inflation here, we can see 2.12 percentage points out of 3 is in services. So that's still by far the biggest chunk. That actually came down. Goods inflation was helpfully steady. Food inflation all but steady. Energy is where you got the biggest lift. And so that's how you end up with core coming down. Core, of course, excludes food and energy. We can see the delta on these. So we get the headline rise of 0.1%, and that's largely because with the rise of 0.17 on energy and the decline of 0.16 on essentially the rest of it, what you end up with is this. So this and that's where they net you. And of course, if you hold aside food and energy, that's where you end up. So either way, non-controversial and not apparently disruptive of anything the Fed might be looking to do, at least in the near term. Now, what's interesting in this equation is, of course, we're looking at something that the market has had already very clearly telegraphed over a month ago now in the Fed's September update of the summary of economic projections. We can see we started with a median rate of 4.4. We got one cut in September, and with a 3.6 number for this year, that amounts to 3 cuts. So we got the September one. The markets are fully baked for October and December, and ought to be if Fed forecasts are to be taken at face value. So there's seemingly no big controversy here between one and the other. We're sort of very clearly looking at something that ought to have been already in the cards. The controversy, as ever, continues to be about what happens next. And if we look here, the Fed is baking in just a single 25 basis point cut through the remainder of next year after these cuts occur. But the markets, of course, are of a less convincing standing. They're looking at 65 basis points for next year, so much more dovish, and erring on the side of 3 cuts as opposed to 1. So clearly, there's a meaningful opportunity here for some sort of reshuffling. And when we consider that we got to this with an upgrade of growth expectations, an upgrade of inflation expectations, and a downgrade of unemployment rate expectations, would seem like the Fed sees a rosier economy than the markets are anticipating in calling for all these cuts. Now, alongside that CPI report last Friday, we also got the S&P Global PMI report, which, to the Fed's point here, gave us an economy that seems to be accelerating. Here's the composite index. Services continue to accelerate here, and the overall economy, of course, follows. Also, helpfully, manufacturing not only back to growth, but also ticking up a bit in terms of the pace of that growth in October. Obviously, as ever, this is done in the logic of PMI. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so what we have here is seemingly, looking at the composite index, growth that is both positive and accelerating. And in fact, we are at this point back to these heady levels from the second half of last year, which we can see actually lined up with the strongest growth that we'd seen since May of 2022 or thereabout. So we're looking at, give or take, 3-year highs or their equivalents on the growth front. And of course, that would be consistent with more inflation and would be consistent with the Fed somewhat constrained in its rate cut abilities. Also looking at the dynamics, despite the fact that we had CPI tick lower here, both for the headline and the core, as we just saw, that's this right here, the 6-month and 3-month trajectories for both headline and core numbers are starting to get uncomfortably higher. Both the 3-month and the 6-month for the headline numbers, obviously starting to edge up relative to this downward draft that we saw from the beginning of the year. Same thing for the core. So we're looking at inflation that's not exactly trending in the direction of endless easing. It might, in fact, be actually doing the opposite. And finally, we also have here this indication from ISM. That's another version of PMI data, but it helpfully has this embedded inflation tracker in it. And what we see is it tends to anticipate what happens in headline CPI and PCE inflation numbers by about 2 months, give or take. Obviously, you can sort of forever tinker with lining this up. Is it 2 months? Is it 3? Is it 2.5? But if we look at this sort of in the spirit of what it's showing, what it anticipates is that from right about here, what we're looking for is an inflationary spike. if this run-up ultimately is going to foreshadow things accurately. And we can see we've started to sort of see that happen. So as this found a bottom and started to come up, this found a bottom and seems to be attempting to match what's going on. So the Fed could be forgiven for anticipating that maybe we've got an inflation issue here. And for that reason, keep its appetite relatively constrained. Importantly, though, we're not going to get a summary of economic projections at this meeting. So if the Fed has any kind of cooling of market expectations that it wants to do, if it's going to walk any of this back or try to talk it down, then we're looking at Fed Chair Powell doing that in the press conference. And we'll see if the markets buy what he says, if that's the way he wants to go. As it happens, we can see markets don't seem to terribly concern themselves with inflation questions going all the way back to May. But we can see already going into mid-July on approach to August, these break-even inflation rates implied in bond markets already start to outright head lower. And so even though going back to May, where things kind of anchored after this start of year decline, incidentally the same one as in stock markets around the onset of tariffs, things anchored, corrected a bit, but already since mid-July, we're heading in the opposite direction. And so the markets don't seem to worry that inflation is going to be a big concern for the Fed and that they'll be able to cut as the markets would like, and perhaps more so than the Fed has allowed for so far. The relationship here, then, is an interesting one. So we're going to get these cuts. That much is clear. And at least for this week and very likely for December. And so the question really becomes, is there anything left from a speculative perspective for the markets to do with that information? We're already, as we can see here, at record highs for the S&P. And the relationship between how this has worked going into this seems to have changed. So again, here's the beginning of the year. Here was the tariff spook right here from mid-February through early April. We can see here as the spook in stocks bottomed out, so too the dovish adjustment in policy expectations bottomed out. But when the rebound happened in stocks and in policy expectations, it seemed to run into a wall right around here, which is the beginning of May, just as stocks got back to where this breakout initially occurred. And everything since then, everywhere stocks have gone, has occurred against a backdrop of policy expectations becoming more dovish, which is probably not terribly surprising. Cheaper money is a good thing as far as stock markets are concerned most of the time. But what's happened since the beginning of October is, again, the relationship seems to have changed. Stocks attempted to top right here. Policy expectations attempted to top right here. But we can see that even as things got more dovish, stocks didn't necessarily rebound. But they are now at the same time that things get less dovish here. And so perhaps we've gotten to a different sort of universe on this, whereby if we don't get anything novel, then we don't necessarily get an impetus for stocks this way or that. And if we do end up with this tightening in a little bit, if the Fed does walk back a little bit these expectations for December rate cuts, it's not impossible, perhaps, that what we could see is a market that ultimately shrugs that off. It may be tentative here yet, though. So we'll see to what extent this relationship evolves now, because it seems to have once again flipped some sort of a switch. in the way that sentiment and policy expectations relate to each other. For the dollar, it's a similarly interesting story here. We can see the dollar continues to recover after retesting this low from July. And although policy expectations have not meaningfully become less dovish on the whole through this anchoring here, we see the dollar, for its part, has stopped falling. Not only that, it's managed to go up here at the same time that we've seen policy expectations seemingly become a little bit less hawkish. So while we have this swing lower in the Fed outlook, the dollar seems to be relatively well anchored and even managing to come up a little. So perhaps it is now ready to go up despite whatever may be happening on rate cuts, at least in the near term. So if all happens as expected, perhaps the dollar actually manages to find its way higher once the event risk is diffused, that is. Now, aside from the Fed, there is, of course, this wallop of major earnings releases. Microsoft, Alphabet, Meta will be the first big batch, and then Apple and Amazon come on Thursday. These are kind of the trillion-dollar market cap club here. And as we discussed earlier, you can see here that tech has generally outperformed so far this earnings season. About 29% of the S&P 500 is reporting. And we can see right here, so far earnings growth for the tech sector has been about 22.3%, whereas for the S&P as a whole, it's been 9.2%. So ostensibly, there isn't the world's greatest concern here that this is going to go the wrong way. We have overwhelming outperformance here. And so with that, there is perhaps, again, a kind of priced for perfection question, whereby we look at this and say, well, if the Fed is all that we know it to be, they're not going to say anything different. They're not going to say anything that's going to spook anyone. They're not going to, in fact, say anything different from what we already know and what is already priced in. If the situation with the U.S.-China kerfuffle is effectively neutered, at least for now, because we've seen these positive headlines ahead of the meeting between Donald Trump and Xi Jinping happening in Korea, again, in a matter of hours here. If that's already something that's diffused an important component of event risk and no longer represents anything other than just validating what the markets have already baked in once it occurs. And then if earnings pass without incident and nothing much happens there, which part of this news coming out is still a source of speculative support for markets? Or are they already fully reflecting everything that there is to fully reflect? And that, of course, presents a buy the rumor, sell the news risk unto itself. That is to say, the markets get everything that they thought they were going to get, no more, no less, and speculative interest then just goes to profit-taking mode because speculation has been made reality and there's nothing else inherently to follow. We'll see, of course, if that's the way this goes or if there is, in fact, at least some level of relief that risk sentiment can still latch onto. As far as exposure goes, I am still looking for this dollar recovery to continue, still short the Aussie, the pound, the euro, the Canadian dollar, looking for the dollar to continue to make headway there. I've added to my short gold position as it continues to inch lower. So I was a seller of calls last week. I've now added into this an outright short on the 1 ounce gold futures, looking for that decline to continue and for the dollar recovery to perhaps flatter it somewhat. Still a little bit short Bitcoin with lots of duration via a put vertical in IBIT. Still long the long end for the bond market, looking for any kind of moderation in near-term Fed rate cut expectations to just push more cuts into the long end of the curve. And the tactical fade on crude oil seems to be working a little bit. It's down 2.4% today, doing it through a USO put vertical, and that seems to be showing some early signs of working. We'll see how that continues to go. That's how I'm positioned going into this event risk. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I usually co-host with Dylan Ranigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Likewise, writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.